Most people jump into the stock market without really knowing what they are buying. They hear a tip from a friend. They see a flashy headline about a company. Or they get caught up in the hype of social media and trending stocks. But that's not investing, that's gambling. If you want to build wealth in the stock market, you need to research stocks the way professionals do. And here's the good news, you don't need a finance degree or years of Wall Street experience to do it. You just need the right framework, the right tools, and the discipline to dig deeper than the average investor. The first thing a pro does when researching a stock is to understand the business, not just the ticker symbol. A stock isn't just a number on a screen. It represents ownership in a real company that sells products, hires employees, generates revenue, and faces competition. So before you even look at the price, ask yourself, what does this company actually do? Can you explain their business model in 1 or 2 sentences? Do they sell a product or service people actually want? Do they have a competitive edge that makes them better than their rivals? If you can't explain how the company makes money, you probably shouldn't be investing in it. The next step pros focus on is financial health. Think of it like looking under the hood of a car before buying it. You don't just admire the paint, you check the engine. For a company, the engine is in its financial statements. Start with revenue growth. Is the company growing its sales year after year? Flat or declining revenue is a red flag unless the company has a strong turnaround plan. Then look at earnings. Is the company actually profitable or are they losing money quarter after quarter? Check the profit margins. A company might bring in billions in revenue, but barely keep any of it as profit. Strong companies usually have healthy margins that show efficiency. Compare those margins with competitors in the same industry to see who is really performing better. Another key metric pros always check is debt. Debt itself isn't bad. In fact, many great companies use debt to grow. But too much debt can sink even the biggest corporations. Look at the debt-to-equity ratio to see if the company is overleveraged. If a company is drowning in debt, even a small economic downturn can wipe it out. Next, professionals dig into free cash flow. This is the money left over after a company pays its expenses and invests in operations. Free cash flow is what fuels growth, dividends, and stock buybacks. If a company consistently generates strong free cash flow, it is a very good sign. Once the financial health checks out, the next thing pros look at is valuation. This is where many beginners go wrong. They see a stock price of $50 and think it's cheap compared to a stock priced at $500. But price alone means nothing. The real question is, what are you getting for the price you pay? That's where valuation ratios come in. The most popular is the price-to-earnings ratio, or PE ratio. It tells you how much investors are paying for each dollar of earnings. But you can't just look at the number in isolation. You need to compare it to industry peers and to the company's own historical average. A PE ratio of 30 might look expensive, but if the company is growing earnings by 40% a year, it could actually be cheap. On the other hand, a price-to-earnings ratio of 10 might look like a bargain, but if the company is shrinking, it could be a value trap. Another useful ratio is the price-to-sales ratio. This is especially important for younger companies that don't yet have profits. It shows how much investors are paying for each dollar of revenue. Again, compare it to peers to get context. Pros also look at this price-to-book ratio, which compares a company's market value to its net assets. This can reveal whether a stock is undervalued or overvalued compared to its actual worth. But remember, ratios are just tools, not crystal balls. They give clues, but you always need the bigger picture. The next part of pro-level research is analyzing the industry and competition. Even if a company looks good on paper, it might struggle if it is in a dying industry. Think about companies in the DVD rental business when streaming took over. They could have had strong financials at one point, but the industry shift destroyed them. So ask yourself, what's the outlook for this industry? Is it growing or shrinking? Is new technology disrupting it? Who are the major players and how does this company stack up against them? Look at market share. A company with a growing share in a growing industry is in a powerful position. But a company losing share to competitors could be a warning sign. Now, let's talk about management. Great companies are often built by great leaders. Research the CEO and leadership team. What is their track record? Have they delivered results in the past? Do they have a clear vision for the future? Also, look at insider activity. Are executives buying shares of their own company? That's usually a good sign because it means they believe in the business. If they are dumping shares, that could be a red flag. Another thing pros pay attention to is dividends and shareholder returns. Not all companies pay dividends, but if they do, check the dividend yield. Is it sustainable? A very high dividend might look attractive, but if it is not supported by earnings and cash flow, it could be cut at any time. Look at dividend growth history. Companies that steadily increase dividends year after year tend to be strong, stable businesses. Also pay attention to stock buybacks. If a company is buying back its own shares consistently, it shows confidence and rewards shareholders by increasing the value of their ownership. Pros also analyze risks. Every investment has risks, but the key is identifying them before you invest. Does the company rely on a single product for most of its revenue? Is it heavily dependent on one customer or one supplier? Is it vulnerable to government regulation or lawsuits? Understanding risks helps you avoid nasty surprises. One more step pros take is reading earnings reports and listening to earnings calls. This is where management discusses results, outlook, and strategy. It's like getting insider access to what's really happening. Pay attention not only to the numbers, but to the tone and language used by executives. Sometimes what they do not say is as important as what they do say. Now, let's talk about technical analysis. While fundamentals tell you what to buy, technicals can help with when to buy. Pros look at charts, trends, and price patterns. They use tools like moving averages, support and resistance levels, and trading volume. This doesn't mean you need to become a day trader, but knowing basic technicals can help you avoid buying at a peak or selling at a bottom. Another pro move is comparing multiple stocks side by side. Don't just research one company in isolation. If you are looking at a tech stock, compare it to its top 3 competitors. See who has stronger growth, better margins, lower debt, or better valuations. Sometimes the difference between a good investment and a great one is simply choosing the right company within the same sector. Finally, pros think long-term. They know the stock market can be volatile in the short run. Prices go up and down daily. But over the long term, what really matters is business performance. If you have done your research and the fundamentals are strong, you do not panic when the stock dips. Instead, you see it as an opportunity to buy more. Researching stocks like a pro isn't about predicting the next big winner. It's about stacking the odds in your favor. It's about avoiding hype, focusing on real data, and making informed decisions. If you follow the process, understand the business, check the financials, evaluate valuation, study the industry, analyze management, assess risks, and think long-term, you will already be ahead of 90% of investors. And here's the most important part: consistency. Pros do not just research one stock and stop. They build a system for analyzing every investment the same way. That's how they find opportunities and avoid traps. The truth is, the stock market will always have uncertainty. But if you research stocks like a pro, you do not need certainty. You just need probabilities on your side. And over time, that's how real wealth is built. So the next time someone tells you to buy a hot stock, don't just follow blindly. Do the work. Dig into the company. Understand the numbers. Look at the risks. And then decide if it deserves your hard-earned money. Because investing is not about luck. It's about preparation. And the more prepared you are, the more successful you will be. If you found this guide helpful, make sure to hit the like button and subscribe for more investing strategies. And let me know in the comments. Which stock are you researching right now, and what is your process for analyzing it? Your insights could help other investors too.